and market movers. This is The Pulse with Francine Lacqua.
Good morning and welcome to The Pulse. I'm Anna Edwards, in for Francine Lacqua this morning here in London. Let's start with a breaking news story. China is said to have ordered its airlines not to take any further deliveries of Boeing jets. It's the latest development in the tit-for-tat trade war between the world's two largest economies. Bloomberg's aviation reporter Danny Lee joins us now. And Danny, this story just breaking right now. What do we know?
Yeah, Anna, good morning. What we are seeing is a broader cachet of companies being caught up in US President Donald Trump's trade war, in which at least Chinese goods, they're being imposed a tariff of up to 145%. Now, what we know this time is that the Chinese government has asked its carriers to stop taking delivery of Boeing aircraft in the meantime, and this extends to aircraft-related equipment and parts from US companies. Now, this order came last week, just as China retaliated on the US with tariffs of 125%, and for the airlines, it makes the economics of buying an aircraft more challenging. It doubles the cost, frankly, and we have heard these warnings from a number of airlines globally, from Delta to Ryanair recently, about the warnings of aircraft deliveries being delayed. But in this case, for China, given this rapidly evolving trade war dispute, we don't know yet if any of these positions would change in the next week or two or longer. We have seen, for example, Donald Trump's position on Apple iPhones, for example, change.
Yes, indeed. Some of these positions have been stuck to by the Trump administration, and some have appeared more flexible, or he has appeared more flexible in how they are applied. So how significant is this then, Danny? I mean, what role, how significant for Boeing? How significant for Chinese aviation? What role do the two play with each other?
Well, it is extraordinary that two of the world's largest economies are facing off, and frankly, that Boeing once again caught in the middle of all of this. And for Boeing, China used to be one of its most important foreign markets as far as the billions of dollars worth of commercial aircraft it could sell into the country. And of late, over the last several years, it's been enormously difficult, and Boeing hasn't won a large aircraft order from a Chinese carrier for many years now. And it comes against the backdrop, frankly, of China trying to develop its own commercial aviation plane-making capabilities. And so it's increasingly being squeezed out in the Chinese market. And when you look at the growth prospects over the next 20 years, the fact that China is going to account for a fifth of all aircraft demand, it does remain to be seen what role Boeing has to play in the years to come. But clearly on something like this, with Chinese airlines being asked to stop taking delivery of Boeing aircraft, Boeing, it said, had declined to comment on this story.
OK, and as we see, the pre-market share price of the pre-market of Boeing is we're seeing this story having impact there. The stock down by 3.7% as a result of this news flow. Thank you very much, Danny. Bloomberg's aviation reporter Danny Lee joining us there. On to another sector that is very much caught up in the tariff story. Auto shares in Europe are higher this morning. That's after President Donald Trump said he is exploring possible temporary exemptions to his tariffs on imported vehicles and parts.
I'm looking at something to help some of the car companies where they're switching to parts that were made in Canada, Mexico, and other places, and they need a little bit of time because they're going to make them here, but they need a little bit of time. So I'm talking about things like that.
For more on the auto sector and the wider trade narrative, let's bring in Craig Trudell, who heads Bloomberg's auto coverage, and Brendan Murray, who's a global trade czar here at Bloomberg. Craig, let me come to you first. Is that it? Is the auto sector out of the woods? I mean, he's talking about them just needing a little bit more time, a temporary reprieve. There's a lot we still don't know here.
Yeah, we don't know. When he said some car companies, we don't know which car companies he's looking at potentially lending a helping hand to. We don't know for how long this reprieve would be, as you mentioned. And this is an industry that does not move in sort of weeks or months. This would take years to uproot where they're making things now and move it to the U.S. I think it's also pretty remarkable in the brief comments that we heard from the president yesterday that he's not necessarily talking about moving parts production or supply base from outside of North America. He wants it from the U.S.'s neighbors in Mexico and Canada, which would be a pretty substantial change for the industry and something that I think, the industry is very reluctant to do because it has operated for decades now as sort of viewing particularly Canada as sort of, one and the same in terms of parts content.
Yeah, the broader picture, Brendan, this morning on tariffs seems to be that the president is giving with one hand to the auto sector, saying, there might be a temporary reprieve, as Craig has described, but then taking away with the other, reiterating that pharmaceuticals and semiconductor, chip, electronics, those are going to be captured by some kind of sectoral tariff in the near future, and there's a probe going on into that. What are we learning about the way that tariffs are being applied by the U.S. administration? Because there does seem to be a bit more change, a bit more flexibility.
Yeah, exactly. So it was almost 2 weeks ago when you remember we had Tariff Liberation Day. There was the big Rose Garden ceremony, a giant tariff wall around the United States economy. And I think what we're finding is the reality of trade wars is that you need doors in that wall. Otherwise, you collapse industries like the auto industry. So what's happening is the president is finding out that in order to carry out the policy that he wants, and that to bring auto jobs back to the U.S., he's going to have to take his time with it, and it can't happen overnight, as Craig said. These are going to take these 232 investigations on autos and chips and pharmaceuticals. They're going to take months and months, and there's going to be a lot of back and forth with the industry to say, with them saying, look, we're going to need some exclusions, we're going to need some more time. So I think you will see more and more of this, more, as you say, flexibility, but it's a realization that these things will take some time.
Yeah, so much for the so-called reciprocal tariffs providing us with clarity, because we seem to still see a lot of oscillation around that starting theme, if you like. Craig, what about the impact on American consumption of cars then? I mean, are we going to see American consumers able to swallow higher prices when it comes to autos? Is that the part of the supply chain that's going to be hit? Is it going to be consumers who have to pay up?
I think that's a big question how disruptive is this going to be when the consumer is already very stretched? We saw in the first quarter that the U.S. set a record for the share of new vehicle loans that were 84 months or longer. So we're talking about 7-year-long auto loans. Already also seeing, ticking up in things like repossessions and consumers falling behind on their payments. So we already have an industry where the average new vehicle is approaching $50,000, and we're talking about layering on top of that, thousands of dollars in additional costs in the form of tariffs.
Yeah.
So a real question about whether or not this is going to unintentionally lead to some shrinkage of the U.S. auto market.
And Brendan, what do we watch for from here? There's the sectoral tariffs then still to come, these various probes by the Commerce Department. We'll watch for the results of those and where they take us. What else in tariff land are we watching for?
You've got two basic tracks. You have governments trying to negotiate the reciprocal tariffs down over the next 90 days, and then you have industries, the chips, the pharmaceuticals, and the autos, steel and aluminum, trying to figure out a way to help the administration accomplish what it wants to accomplish without crashing the economy. This Boeing development, too, that you started off with, it'll be really interesting to watch how the White House responds to that.
That was a significant one. Thank you very much to both of you. Thanks to Brendan Murray. Thanks to Craig Trudell. Now, the U.S. Treasury Secretary Scott Bessent has played down the recent sell-off in the bond market, rejecting speculation that foreign nations are dumping their holdings of U.S. Treasuries. In our exclusive interview, Bessent also flagged his department has the tools to address any dislocation if it's needed.
I don't think there's a dumping, and I think we saw in the tick data either today or Friday that actually foreign ownerships picked up.
So you don't think it's sovereigns, potentially it's hedge funds unwinding?
I have no evidence that it's sovereign.
That's the view then on the Treasury market and what caused that spike up in 30-year yields, perhaps then leaning more towards hedge funds rather than what we see from sovereign holders of Treasuries, notably Japan and China. Let's have a look at where the dollar is right now, because we also heard from Scott Bessent in that interview, him saying that they still have, as an administration, a strong dollar policy. Well, the dollar has not responded very strongly to what we've seen coming out of the White House now. He cast his mind back, of course, to the first Trump administration and was talking about what tax cuts and other measures delivered later on in the first Trump administration. So we'll see if there are any parallels there. Let's talk FX then. Jeremy Stretch, head of G10 FX strategy at CIBC, joins us here on set. Jeremy, morning. Nice to have you with us. Let's start with the dollar then, and the role that the dollar plays in the global economy. You can't move for conversations about whether the dollar is still the reserve currency. I wonder your view on that, and whether it matters if there is not one clear alternative, or whether we end up breaking things up and we don't have to have one key reserve currency. What's your thinking?
Well, of course, the US has relied on that exorbitant privilege over the course of the last 40 or 50 years to really drive investment flows into the US Treasury market. Now it seems to be the case that obviously there are investors now starting to question whether that sort of mentality and that certainty about the dollar dynamic is going to prevail, and whether there is going to be a more liquid alternative. Now, of course, I've been around long enough to remember pre-Euro days and how that was debated as that was going to be the currency of choice that was going to really challenge the dollar. And indeed, it started to do that until the global financial crisis, and then the Eurozone crisis, and then negative rates in the Eurozone. But I think we are now starting to see investors once again questioning whether the US is quite the reliable partner or the reliable ally in the context of the NATO discussions that we've also been seeing over recent weeks. And I think that's going to question whether the flows are going to be the same sort of magnitude as we go forward. And I think what we might find is that those Eurozone current account surplus areas, or whether it be the Eurozone or whether it be Japan, have a degree of crowding in of investment, and that will probably provide a stronger narrative for both the euro and the yen over time.
Right, yes. We were talking to Jane Foley earlier on from Rabobank, and she was saying that the euro, let me get the words right, the euro had done a good impression of a reserve currency over recent sessions. I mean, is that the way you think about it? Simply because she said it's not been around that long, 25 years, and various other reasons that you point out? Well,
indeed. I mean, obviously the issue in terms of the eurozone, if it really wanted to be a reserve currency, it needs to have the depth of capital market. And of course, we have the depth and liquidity of the Bund market, and investors have obviously been buying into bunds quite significantly of late. But of course, there are other markets within the eurozone where investors are perhaps a little more reticent, despite some of those yield pickups. But I think it is the case that the eurozone is once again seeing increased focus and increased interest. And so I think we will see over time that sort of euro reserve holding starting to move back higher again, and those central banks and reserve managers that were obviously put off by holding euros during that negative yielding period starting to progressively coming back. So I think that's going to be the process. And it's what I call passive diversification. As countries accumulate more and more reserves over time, I think the proportion of those reserves held outside of the dollar will gradually increase.
OK, and do you think that, I mean, the strength of the euro that we've seen of late, in some people's view, is enough to at least ask questions about whether we get a 50 basis point cut this time around from the ECB? I think consensus is just 25 basis points. But how are you thinking about Thursday?
Yes, I think it's very much a likelihood of a 25 basis point move. I wouldn't be surprised that after the event we get some of the source stories suggesting some of the hawks, perhaps Ms. Halt from the Austrian Central Bank, for example, are perhaps rather less happy with the idea of continued policy easing. I don't think the appreciation of the euro is going to create any real significant discussion regarding 50 basis points. Yes, it may be mentioned at the margins, but I think we are still in the realms of more normal policy adjustments for 25 basis points here. And of course, it's a meeting where we don't get updated staff forecasts, so it's not as though there's going to be a significant driving factor. Yes, Madame Lagarde will underline the uncertainties around the growth dynamic and the inflation construct via tariffs, and I think that probably underlines the fact that a sensible, gradual strategy probably still remains very much evident.
Now, there seem to be a lot of people who say China owns a lot of treasuries, but is not going to use them as a weapon in this trade war against the United States. And part of the reason for that is what it would do to its own holdings, but also what it would do to its currency. So what do we need to know about its currency management, Jeremy, at this point, that helps us understand what they do with that treasury holding?
Well, I think obviously we've seen a gradual paring back in terms of the treasury holdings. I don't think they will necessarily start to sell them, but I think even in the context of the debate about further inflows or further flows, I think has an important dynamic. So in a sense, that was one of the reasons, rationales. It wasn't necessarily that it was selling treasuries last week, and I think probably Mr. Bessent is probably going to be right in that regard, but it's at least the perception of flows not going back towards that treasury market will start to have a diminishing or a detrimental impact in terms of treasury performance. I think in terms of the currency, I think the authorities will be happy to tolerate a slow but gradual cheapening up in the nearer term. I don't think they're going to be using the currency as a trade weapon either. And I think in a sense the Chinese authorities will be very keen to make sure they provide stimulus and support for the key dynamics for the Chinese consumer. That relates to the real estate market and that relates to the equity market. As long as those channels remain well supported, then I think that can drive the consumer narrative and will help to offset some of the trade concerns.
What could create a dollar bounce? We've seen little bits, but, nothing substantial. Are you watching for something?
Well, I think what we've seen a substantial and very aggressive move in a very short space of time. So I think a degree of consolidation. So I think, people will probably be hoping that in this Easter week there may well be a little bit of a paring back in terms of the news flow, in a sense, and perhaps we can get a little bit of a stabilisation in that particular context. I think, though, we're in a reality where people are looking for any dollar rallies to provide opportunities to start to get long again. So if we see euro-dollar, say, at 112.5, that's probably a good buy signal once again. So I think it's a case that we've moved a considerable distance. We've seen positioning change very significantly. A pause and or a paring back of the tariff news for a temporary period and a little bit of resilience in the equity market might just provide a little bit of resilience or a rally in the dollar. But I think that would just provide better levels for investors to come back to look to sell again. OK, Jeremy, thank you very much. Jeremy Stretch, head of G10 FX strategy at CIBC. Coming up, somebody has been making a lot of money out of some of the volatility out there, and we've heard a lot from Wall Street banks on that front. They continue to report earnings, with Goldman's traders notching up records. That's certainly on the equity side, while Citigroup and Bank of America hit the spotlight later today. What should we expect? We'll bring you that preview next. This is Bloomberg.
Markets will likely continue to be volatile until we have further clarity. The administration's focus on trade barriers and strengthening the U.S. competitive position is commendable. At the same time, it is important to recognize that few companies have benefited more from the post-World War II economic and financial order than the U.S.
David Solomon speaking during Goldman Sachs' earnings call yesterday. Bloomberg's Charlie Wells is here to bring us up to speed on everything we've heard so far and what we're likely still to hear from the banking sector. Charlie.
Yeah, Anna, so we're entering that final mile of the big bank earnings season for that first quarter. And, the prior quarter was actually very great for a lot of these banks, particularly on that equities trading front. But what everyone really cared about and has continued to care about in this earnings season is what these banks' projections were going forward, given the state of the trade war. And what we heard from Goldman yesterday, well, we actually didn't hear that much about tariffs. It was not mentioned on that call at all. But we did hear about material impacts of a long-standing trade war and a hope that these issues could be resolved quickly. Also a hope for deregulation and a lot of the ideas that were being presented earlier on after the Trump victory in November. On tap for today, we're going to get Bank of America and Citigroup. And again, the questions here are going to be, what exposure do these large institutions have to a potentially protracted trade war? What exposure, say, does Citigroup have due to the fact that it has quite a large card business, that it gets a lot of its revenue from abroad? And questions as well on Bank of America, what their net interest income trajectory could look like if we get to a place where the rate picture is just not as positive for that bank. So we're expecting, some of this confidence that CEOs have been expressing, but also an admission that there's a lot of uncertainty still.
OK, Charlie, thank you very much. Bloomberg's Charlie Wells with the latest on the banking sector. Let's stick with this theme and bring in Joost Beaumont, who's head of bank research at ABN Amro. Joost, let's start with the positives, shall we? And where many in this sector, I was going to say Goldman, but actually I think it applied to JP Morgan, Morgan Stanley as well. The bright spot around equities trading, no surprise, I suppose, given the amount of volatility and the volume the volume demand that was created by all those news headlines. Is that sustainable, Joost?
Now, at least it's maybe as good as it gets. And of course, indeed, I think that's the key takeaway from the Q1 numbers so far in the US is that especially the investment banks benefited substantially from the volatility in the markets. Equity trading, of course, April Liberation Day was in Q2, so that might bode well for earnings this quarter as well. But like you said, there are a lot of dark clouds hanging over the market, and it remains to be seen whether they can keep up with the pace of this.
Yes, where do you think those dark clouds manifest themselves then, Joost, for the sector? Is it going to be the more consumer-facing businesses where if we see some kind of consumer downturn as a result of higher prices, that's the way that this comes through and hurts the banks? What's the feed into, how does this feed into the banking sector?
Yeah, I think it's a bit twofold. If you look at the mainly retail-focused banks, of course, they will be hit. Of the biggest risk here is NPL, so non-performing loans. How will their customers behave? We see, of course, in the US, delinquencies of credit card loans, but also car loans are rising quite substantially. At least the direction of travel is heading north. So we could definitely see more pressure on US households now that we will enter a stagflation period. So NPLs are likely to rise. Of course, also banks need lending growth with rates remaining higher for longer. And with the uncertainty that is clearly there, it remains to be seen whether investments will pick up. So lending growth is likely to remain quite meager as well. Which will definitely be a challenge for banks and to keep their net interest margins at solid levels. But that's more for the retail banks, and of course the investment-focused banks. I think Goldman already showed it earlier. The M&A activity with the higher rates, and also again the unpredictability about the future has led to kind of collapse in M&A activity.
Yeah. Yeah, it seems that M&A not quite what some had expected at the start of the year, the turn of the year. Expectations were higher. What about on the regulation side? We heard from David Solomon yesterday. He listed quite a lot of areas where he had high expectation around deregulation, so capital, leverage, liquidity, supervision. What's your expectation there, Joost?
In terms of regulation, of course, there's clearly more globally currently kind of an urge to deregulate the banking sector. I think we need to treat this a little bit with caution. If we get too much deregulation, that could sow the seed for some damages along the road. In coming years. I have to think about the Silicon Valley Bank, which benefited from some deregulation in 2018, but in 2023, of course, it went bust. Maybe different reasons, but I think we need to treat deregulation with caution. Of course, it can benefit banks. But the biggest challenge is really the real economy, the risk management, which clearly comes to the fore now. And the banks that have this in place will do better than the others.
Joost, just very briefly, do we get any changes in regulation quickly?
Change the regulation doesn't go very, very quickly, but we might get some that could be supportive, but challenges remain quite large, to be honest.
Joost, thank you very much. Joost Beaumont, Head of Bank Research at ABN Amro. Coming up on the programme, we'll get back to some of the sectors that are on the move this morning, and certainly high up on the list then is luxury. The luxury giant LVMH, really underwhelming, reporting a 5% drop in revenue in its largest division. Both the US market and the Chinese market under pressure, not delivering what analysts had expected. We'll discuss the sector's slowdown. Is it limited to those leather and fashion items? How did Sephora perform? What impact is this having on the rest of the sector? We'll get into that conversation next. This is Bloomberg. Good morning and welcome to the Pulse. I'm Anna Edwards in London, in for Francine Lacqua this morning, and these are your top stories. Auto shares drive gains in Europe after President Trump floats a potential auto tariff pause, but reiterates new levies on pharmaceuticals and semiconductors are coming. US Treasury Secretary Scott Bessent rejects speculation that foreign governments are dumping US debt. We'll bring you more from our exclusive interview. And a Bloomberg scoop, China orders its airlines not to take any further deliveries of Boeing jets as the trade war with the United States reaches new heights. We have movement in the luxury space this morning, and that's where we will begin this part of the programme. LVMH shares are dropping after the group published weaker than expected sales, weighed down by sluggish demand for high-end goods in China and the United States, and the threat of a trade war. We have on hand, of course, Andrea Felsted from Bloomberg Opinion to talk us through what is happening here. Andrea, good morning once again. So what does this tell us then about luxury demand? What did we learn here?
We didn't learn very much, actually. So the biggest swing factor was a year ago, lots of Chinese consumers were going to shop in Japan to take advantage of the weak yen. That's still happening, and they're still buying at home to the same extent. But it's not as spectacular as it was a year ago. So that's sort of, mathematically, that's dragged on the performance. In terms of tariffs, the US demand for fashion and leather goods and watches and jewellery is held up. Now, there were two areas of weakness. One was Sephora. That also had very strong growth a year ago, so we might be getting some comparison. And also wines and spirits. Now, Sephora and wines and spirits could have been hurt by the tariff uncertainty because both of those appeal to a broader consumer base, i.e. not the super wealthy who tend to be more affected by inflation, slowing growth, employment market. So that we could have a bit of impact there. We haven't seen a broader impact yet.
And what about the read across into other businesses then? Is this LVMH specific? A look at the luxury names in Europe tells me no, that there is read across into both other luxury businesses, but to your point about drinks, into a wide range of luxury businesses and drinks makers.
Exactly. Concerns about L'Oreal, given the Sephora, all the drinks makers sort of worried about whether we're going to see a pullback from tariffs. It's interesting that all of the luxury brands have been hit, and you've got Hermes, which hasn't fallen by as much, but it's still down. Richemont, those two are probably more insulated. Obviously, we all know Hermes has got waiting lists for its bags, so if demand falls, it can simply, go to the next person on the list. If the person at the top of the list doesn't want the Birkin, there'll be someone else who does. Richemont gets more than 50% of its sales from jewellery, and jewellery has proved to be more resilient than fashion and leather goods because actually, although jewellery is expensive, the prices haven't gone up as much as for handbags. So there's also a bit of a maturity. We've all been buying handbags for the last 15 to 20 years. Jewellery is something different and at a slightly lower stage in its development than fashion and leather goods.
Yeah, and if I look at some of these luxury names, some of them have had a really tough year, haven't they?
Yeah.
I mean, it doesn't matter if you go back year to date or back 1 year. I mean, I'm looking back 12 months, and we've got Kering down half its value lost, 52% weaker.
Yeah.
It's wider than just luxury. It's other consumer names as well. Puma, for example, but Burberry, Christian Dior, LVMH, all a tough time. So these stocks have come off a lot, Andrea.
Now, I think the corollary to the Hermes Richemont story is if you're in a transition like Kering's Gucci or Burberry, it's much harder to do that in a difficult market. So Gucci's got a new designer trying to revive excitement in the brand. That's going to be much more difficult because when times are tough, we tend to gravitate to the names we know. We don't want to take a risk on a new designer. Is it going to stay in fashion? Is it going to hold its value? So their job just got much harder. And despite those share price falls, I'm not sure that's fully reflected.
OK, Andrea, thank you very much. Andrea Felsted from Bloomberg Opinion with the latest on that sector and how it's faring in today's market after those numbers out of LVMH. Well, one of the areas of weakness, of course, was China, and let's stick with the China theme. China's president is calling on Vietnam to jointly oppose what he calls unilateral bullying to maintain global free trade. Chinese state media says Xi Jinping made the comments during meetings with Vietnam's leaders yesterday. US President Donald Trump imposed a 46% tariff on Vietnamese goods before announcing a 90-day pause. Vietnam is seeking more balanced trade with China and cooperation on security. Meanwhile, US Trade Representative Jameson Greer tells Fox News that we can expect talks between Donald Trump and Chinese leader Xi Jinping in the near future. This comes amid an escalating trade war between the two countries.
China is the only country that actually implemented its retaliation and set it on this course. So obviously that's concerning, and the president has been very clear that he's willing to talk to his counterpart and that he expects that at some point we'll have talks. We're not there yet, but that's his expectation, and I share that expectation.
Joining us now for more on China, then, Yi Zhe, Senior Research Fellow on China in the Asia-Pacific Programme at Chatham House. Very nice to speak to you, Zhe, about what's going on here with China. In terms of cooperating within the Asia region, do you see prospects for more collaboration with China from Vietnam, from other countries in the region who maybe in the past have built alliances with the United States but now are not quite so sure of those alliances?
Thank you, Anna, for having me. Obviously, I think the answer is yes. Yes, for the reason it's not exactly just for the economic rationality. I think it's mostly for the reason of being predictable. I think part of the reason for what Donald Trump has introduced, the tariff, imported it into Southeast Asian countries in the past week, that really is sending a shock wave across the region and make many Southeast Asian economies consider, is United States as something, a country which is reliable, and if it continues to imposing punitive tariff like this to hurting their own economy. So I think in a way, it is actually inadvertently what the U.S. has done inadvertently push those Southeast Asian economy become more integrated with China and also politically more aligned with China at the same time. So I think that's also part of the reason why Xi Jinping has orchestrated and convened the meeting on the so-called neighborhood policy meeting last week, and one of the core cornerstone of China's foreign policy from the past.
Yes. It's interesting, then, we're talking about this in the Asian context. We're also talking about this in the European context, that the EU perhaps is incentivized to cooperate more amongst the nations in Europe as a result of President Trump's policy. But sticking, of course, with China in this conversation, how do you think about the tools that China has at its disposal to respond to the United States here and the tariff war that we see? Because we've seen, of course, increased tariffs, but then China said, that's it, we don't plan to go any higher. So which tools do you think China will rely on from this point?
Well, I think there's two boxes. Beijing has not really used it for now. And firstly and foremost, much of discussed domestic economic stimulus that some of the economists might expect government to unleash later in this month. And firstly, they have not used it. And I think secondly, we'll probably could see even more stringent export control on the critical minerals and also the critical minerals processing, which China has the absolute monopoly for that. Now, thirdly, I think we have not seen Beijing begin to entertain that idea of dumping the U.S. treasury bond. So I think there's three things that we have not seen so far. But also, I think on the other hand, the part of the reason why Beijing does not want to play this number game anymore is actually give a step for Donald Trump. Donald Trump can rightly justify to his domestic audience by saying, look, because of my maximum pressure towards China, and this is actually allowed me to play with the long game with Beijing. So actually, I think both sides will have some game to play in here. Although, judging from the previous interview that you have recorded with USTR chief representative, I doubt the Chinese really want to enter in some kind of negotiation for now. I think they're going to be hanging there for quite a while.
So you think we're in this situation with this elevated tariff regime for quite a while then, Jia? You don't think that negotiations happen quickly at all?
Well, I think what Beijing senses that if Donald Trump wants to play defiant, and then Beijing is willing to play this sense of defiance over a long way, and also this is part of the reason that the Chinese export is relying far less towards the United States than compared with 8 years ago in the first round of the trade war. So that sense of over-reliance towards the United States has significantly reduced, and this actually offers some sense of buffer for the Chinese manufacturers. So I think that's the reason Beijing is not really willing to play a long game in here.
And what about the use of Treasury assets? What about the use of China's holding of US Treasuries? You said that, this is one of the tools they have at their disposal. Lots of guests, though, tell us they're not going to use it. But I did see one Bloomberg economist writing yesterday that China might not have to sell very many Treasuries to lean into a lack of enthusiasm for treasuries at this point. If the wider market is not very keen on treasuries, then it might not take China to sell very many to have a big impact. Is that something that you think, an argument that China is thinking about?
Well, I think it's less about the economy and financing here. It's more about the psychology. And if Beijing, as the largest holder of U.S. Treasury bond, began to entertain this idea of dumping U.S. Treasury, I think perhaps other countries may follow the suit. So this actually would lead into a further market turmoil. So I think it's more on the psychological factor that Beijing is now putting a threat of doing this, but not actually doing it. So that's where we are.
Yeah, we've seen China, our story just moments ago, in fact, saying that China has asked its airlines not to take further delivery of Boeing aircraft. I suppose this is the kind of policy that we could see. These are big ticket items, big, expensive capital goods items. That could be an area of focus.
Well, this is one area for aircraft, but there's another area which we have not discussed so far is on agricultural products, which is make up the majority of U.S. import towards China. I think part of the reason for this is that China also look into who are the MAGA core supporters. And of course, there's a certain sectors of American agriculture sector support Donald Trump wholeheartedly. So China would actually be making those farmers hurt the most and hoping that those farmers and also the activist group will be able to persuade Donald Trump to withdraw the tariff that imposing on China. So I think really on agricultural products, we're probably going to see a very similar pattern that China are going to continue to be refusing import from the United States and instead looking for alternatives, and which has already looked into alternatives in the past few years from Brazil, from Argentina, from Russia, and from Ukraine. So I think the agriculture sector is also worthwhile to look into.
Yes, that's worth remembering from the first Trump administration as well, isn't it? Thank you very much for joining us then. Zhizhe, thank you very much for your thoughts. Senior Research Fellow on China in the Asia-Pacific programme at Chatham House. Now, she was just referring there to the interview we had with the US Treasury Secretary Scott Bessent, who is hitting back after China's finance ministry called President Trump's 145% tariff on the country a joke. In an exclusive interview, Bessent told us there could be a decoupling between the world's two largest economies. He also says he's committed to getting trade deals done with several other countries in the next 90 days.
I think now that we have the China tariffs in place, that they are going to want to have some protection from Chinese goods flooding their markets. That China's business model is like from that Disney movie where the brooms are carrying the buckets. Like they're not going to stop manufacturing because the U.S. has a tariff wall up, so those goods are going to go somewhere.
Where do you think they're going to dump?
Well, I think it depends on the good.
Well, we have exemptions now, though, for electronics, so we still expect electronics to come into the United States with the smaller tariff rate, the fentanyl, 20%.
But you were asking where are they going to dump. I think it will depend on what is the good. You know, higher value-added manufacturing goods, likely in Europe, Canada, in the G7, and then kind of more of the baubles and knickknacks in the global South.
China's Commerce Ministry came out when the tariff rates were going above 100% and called it, quote, a joke. Has there been negotiations on any level between Beijing and Washington right now?
Well, look, it'll come from the top. President Trump, Chairman Xi have a very good relationship. And I wouldn't say that these are not a joke. I mean, these are big numbers. I think no one thinks they're sustainable, wants them to remain here, but it's far from a joke.
Well, they just say that the rate is so high, it's become a joke. Basically, does it just stop trade between Washington and Beijing altogether? Do you see a decoupling of these two economies?
Well, maybe the trade minister has a different sense of humor I do, but I don't see anything funny about it.
Do you see a decoupling, though, between Washington and Beijing?
There doesn't have to be. There could be. There's a big deal to be done at some point, but look, what is different with China that is different in the history of trade that normally, if you go back to the big trade deals or the currency deals in the 80s, the Plaza Accord, the Louvre Accord, the Reagan auto deals, our leading economic competitors were our military allies. China is both our biggest economic competitor and our biggest military rival. So that's going to require a special kind of formula.
Are you teasing out a Mar-a-Lago Accord that we should be paying attention for in the future?
I'm not sure what you're talking about.
Well, potentially getting all these trading partners together to discuss fair, balanced trade?
Well, we're doing that over the next 90 days.
U.S. Treasury Secretary Scott Bessent speaking exclusively with Bloomberg's Amro Jordan in Buenos Aires, in fact, talking about those global tariff conversations. Coming up, President Donald Trump floats a tariff reprieve for automakers as US-EU negotiators try to reach a deal. We're live in Berlin with the latest on the EU tariff conversation. This is Bloomberg.
I think there will be advantage to our allies, especially, and a first mover advantage. Usually the first person who makes the deal gets the best deal. So
who do you think will be first?
It's their choice. I think there could be numerous countries who are going to move with all deliberate speed. And again, it's going to be a process. The tariffs are the easiest part. So a country with high tariffs, you can just say, okay, this, get rid of it. It's the non-tariff trade barriers that are more insidious, more difficult to spot, and it's probably going to take a little longer to exercise those demons.
That was the U.S. Treasury Secretary Scott Bessent speaking exclusively to Bloomberg, of course. Now, the EU Trade Commissioner, Amro, says the EU is ready for a fair deal with the United States after meeting with Commerce Secretary Howard Lutnick. For reaction from Europe, let's bring in Bloomberg's Oliver Crook, who's in Berlin and has been tracking this. So we heard very limited lines, I think, from Amro, but a bit of detail in there then, Ollie. What is the latest on those US-EU negotiations?
Yeah, and everybody wants a fair deal. Everyone has a different idea of what exactly that means. So Amro had a basically 4-hour meeting with Howard Lutnick and Jameson Greer yesterday in Washington, D.C. He's coming back now to Europe to brief European diplomats in terms of the fruits of those labors. He put out this tweet after that conversation saying that the EU remains constructive and ready for a fair deal, including reciprocity through our 0-for-0 tariff offer on industrial goods and the work on non-tariff barriers. So let's just break down those two sort of sides of the coin. The 0-for-0 is basically zero tariffs for 0% tariffs on industrial goods. This effectively would erect a free trade zone between the EU and the United States. And we should say that before the sort of new tariff regime that's been installed by the Trump administration, you were not exactly at 0-for-0, but the sort of trading discrepancy in terms of tariffs between the EU and the United States was only about 0.5 percentage points, right? It was very small to begin with. So the U.S. administration is really going to be looking for a lot more. And what they're going to be looking for are these so-called non-tariff barriers, these sort of exercising the demon of the non-tariff barrier. The problem for the Europeans is that the U.S. administration has still failed to identify what exactly these are. When you ask, for example, Peter Navarro over the weekend, he says he wants to target a value-added tax, which is basically a sales tax in Europe. You talk to European officials about that, they say this is basically just a sales tax on goods, not only imported, but also domestic goods in Europe. That is basically off the table. We talk about food safety standards. We heard about beef again from Donald Trump yesterday. There are other places where you might actually be able to make progress. We heard from the German finance minister last week. They're talking about potential regulations on automobiles. If you had the same regulations in Europe as you had in the United States, a car that's produced in Detroit could be sold into Europe basically with no other changes to the car because the two regulatory regimes are aligned. But Anna, really the fine line here, I think, is for the Europeans trying to give something to the United States on this question of non-tariff barriers, while at the same time not appearing to basically be taking legislation from Washington, D.C.
Yes, it does seem as the U.S. administration does want to see more U.S. cars being sold in Europe. I'm just not convinced that they will all fit on all of Europe's roads, but maybe that's a challenge that the U.S. administration would like to take and prove that it's possible.
Non-tariff barrier.
Yeah, exactly. There we go. What about the China-EU relationship at this point? We've heard from Spain quite a lot recently that they would like to see that as an area of more focus.
Yeah, so what's interesting is the Spanish really are sort of outliers, I think, in this discussion. What we've heard from Spain is that they want to have stronger diplomatic ties with China, stronger economic ties with China, more investment from China within Spain and the European Union. That is a notion, despite the sort of erratic activity from the United States, that has not really gained a huge amount of traction in broader Europe, right? You talk to other officials from other countries, they really do not want to move closer to China because remember, Anna, before Trump was elected president of the United States, the main economic threat to the continent of Europe was perceived by the Commission to be China. What we are now seeing, and I think is interesting, is potentially a development in the United States where you have a slight disagreement between Scott Bessent and Donald Trump, where Scott Bessent, it seems, would like to get some of these allies on side. He'd like to sort out the trade questions in order to potentially form a more collective approach between the United States, between the Europeans and others against China potentially on trade. For the Europeans, as far as they're concerned, that is pushing a little bit on an open door. This is something that the Europeans are alive to, the risk that the Chinese economy poses to the European economy. That being said, until the Trump administration, and really Trump is the only one who's going to be making this decision, decides not to wage war on everybody at once, it may be difficult to get that collective approach. That being said, it is something that the Europeans could potentially be open to.
Oliver, thank you very much. Bloomberg's Oliver Crook with the latest on the EU-US relationship and the EU-China relationship as well. Well, let's have a quick look at where we are on the US futures picture then as we move more towards the US portion of the day. This is the futures picture then up by 0.2% on E-minis. NASDAQ futures up by 0.3%. So off highs a little bit. We have, of course, seen a real pullback in equities as a result of nervousness around tariffs. We're unwinding some of that today. And the things that President Trump has said around autos tariffs and perhaps a little bit of willingness to show some flexibility and reprieve on the autos front, that's certainly helping here in Europe, and we'll see what that continues to do over in the United States. If we see pullbacks in stocks, do they represent a buying opportunity? We heard from the CIO over at Deutsche Bank a little while ago.
Yeah, we've said we buy the dip in the market if it's closer to recessionary levels. And I think the top, if you look, was mid of February, 6,100 in the S&P. So I think whenever you see or have seen levels below 5,000, 4,800, we think that's rather a buying opportunity. And we have not changed our view on this one. So I do expect more volatility, but whenever we go closer to recessionary levels, I think it's a buying opportunity. Let's not forget, I think there's still a lot of potential growth rate in the US, and that's something which is still interesting for investors from our point of view.
Yes, it was just months ago we were getting so excited about US corporates and AI and the links there and the exceptionalism there. We will see how long it takes to return to that theme for the global investor community. That was Christian Nolting, Deutsche Bank's global CIO there. Let's have a look at how some stocks are performing today, in particular the auto sector. We'll get to luxury in just a moment. But in terms of the auto space, we see some real movement here. This on the back of those comments from President Trump yesterday saying that he is looking at the idea, floating the idea that we could see some kind of temporary reprieve for the auto sector and auto parts sector. There wasn't a huge amount of detail in that, but it was enough to send US automakers higher during their session. It then filtered through into the Asian session, and we saw some of those moving higher and into Europe as well. So we see Stellantis, of course, with its substantial US presence, up by 5.2%, and it is helping some more of the European automakers as well, or more European makers, Mercedes, BMW, for example. On luxury goods, let's have a look at that one, because this is another sector very much on the move, but to the downside. And this is to do with tariffs to some degree, but also just to do with the earnings story that LVMH presented. Partly this is China-driven, so weakness in the Chinese sales number there, not as much as they'd expected. There are other tariffs we could talk about on cognac, for example, over in the Chinese market. And then in the US side of things, LVMH also disappointing with what it reported on the US consumer. And that, as you can see from the board there, is weighing on sentiment across other luxury names, so Burberry, Kering, Hermes. And as Andrea Felted was telling us earlier on, those businesses that are trying to turn around luxury, it's even harder for them, perhaps, to do that in this difficult overall luxury environment. Ericsson, also worth a mention, this telecom equipment company up by 6%. And this is an earnings story, but is this just earnings that have been pulled forward ahead of tariffs? That seems to be one of the conclusions you could get from reading some of our coverage on that, the business this morning. But the stock is up by 6.3%. Now, I mentioned what's been going on in some of the industrials, the automakers sector earlier on. Later today, we will be speaking with the Hyundai CEO on how South Korea's largest automaker will try to navigate Trump's tariffs. That conversation will be at 3:30 UK time, so that'll be an interesting one to tune in for. Up next, a Bloomberg Brief will take you into all of the stories you need to know ahead of the US Open. This is Bloomberg.